Oh, here we go.
Oh, that's so weird. I didn't realize you guys were there. Have we started recording?
Oh, you look the part.
Oh,
I'm embarrassed. I didn't realize you were all there.
What is everything you're wearing there, Don? What does it relate to? I haven't heard anything about this.
So I think I spent more on merchandise than the event itself. I've got the towel, I've got the hat, I've got the shirt, I've even got the socks, but I didn't realize I bought small socks until about 40 Ks into the ride because I was wearing them and I lost a lot of blood flow and I got very bad pins and needles. So.
Oh, wow.
well,
So.
Oh, no, but well done. You finished.
well
you did
done.
All right, let me get you. Okay. That's
No,
enough.
you leave it on, please.
Yeah, leave it on the whole episode. You got to.
I can't. I
You have to
can't.
now.
You have to. This is
Do it to
nuts.
him, John.
Come on, you've been talking it up for long
Yeah.
enough.
Is
Half
this
Iron
the
Man.
time that I also meant? Well, this is the thing. So you know how people buy like a Porsche Cayenne or what's like a Range Rover Velar,
Yeah.
and
Yeah.
they say I drive a Porsche and a Range Rover's like, no, you don't. It's the same with doing a half Ironman. So I've now registered and paid for the full Ironman.
Oh, wow. 2 weeks' time?
Are you in Cairns? Where are you doing it, Don?
No, the problem is our London mission conflicts with Cairns, so I've got to do Port Macquarie in May.
Cool.
Port Macquarie.
Bustleton in December was too far away. I'd lose motivation and would never get it done. I can't look at myself anymore. I have to.
No,
do
Don,
something.
please, Don.
No,
No,
I can't.
no,
I
this is-
can't.
this is
This is
payback.
too much.
Don, it would be that funny.
I think next time we're in Brisbane, we should get those printed photos of him to put on his wall behind.
Oh, yes.
Where that little
Wow.
photo print is.
Oh,
There's
His
actually a funny
Christmas
story.
present.
So dare I ask what you guys did on the weekend?
oh, nothing in comparison to what you did. Well, actually, there is a comparison. I ended up in the emergency room on Friday, pretty much unable to walk because a short run totally screwed up my back.
Age
so-
is a terrible thing.
Yeah. I was hoping they would find something so I couldn't, other than just being old. But no, I'm just old and I fucked my back.
Jack, rugby season's over. What do you do now? You just lie on your lazy boy and
Yeah, that's about right. No, I flew back to Adelaide on Saturday. So I spent Friday night and Saturday morning on the Goldie, caught up with some friends and family.
now let me just find this. Hang on. Oh, hang on. Is that working?
No.
No, it's not working. Hang on. Stop. Well, why isn't that? They won't let me press the live, but everyone can see or hear the played media file and will. Well, that's a disappointment. What about this one?
Sounds
Okay, we're going to have to do it. I was trying to do the drum roll and cheering function. That's here we go. No, sorry, wrong order. Here, hang on. No, wrong one. No, that's jump roll. Hang on. Yeah. Okay, you ready? We'd like to welcome Ash to the team.
Oh, well done.
And for the record, it doesn't get any better or more professional or anything. This is literally the. So Ash, please introduce yourself.
Hi, everyone. I'm Ash. I joined the Tribe team. I have been in the US for about 9 years, having done college there and worked at JP Morgan in hedge fund sales. Moved back to Australia during COVID and have been working in the startup and entrepreneur space, working with large corporates. Really excited to be on the Tribe team, looking after investor relations and keen to chat to anyone. So my contact details are on the website. And so feel free to reach out on email or LinkedIn.
And you're 10 minutes into recording a podcast with us and you haven't quit yet. So that's a positive.
Yeah, it's positive.
Well, the question I've got is, what are the series of wrong turns in life that you've made that have led you to be hanging around us?
Oh, God, we need a glass of wine for that. It's not a cup of tea type of conversation.
No, well, it's awesome. You're based in Adelaide as well with
Yes.
Jack. So our
50-50
Adelaide.
now.
Exactly.
Yeah. Awesome to have you on the team, Ash.
Thanks, guys. Excited.
Now, to be fair on Ash, as Jack would agree, it can take a little bit of time to warm up to how we roll. Would that be fair, Jack?
Yeah, I think it probably took me 50 episodes of sitting in the corner and then like feeling more awkward because I wasn't talking, so I had to talk.
Let's get into the schedule. We'll do a bit of a recap of some items from previous episodes. So Uber bought Car Next Door for what, 105 million?
Yep.
2 years ago, shuts down that acquisition, goes quiet for no more than 2 weeks, and has now come out. It's done a partnership now with a company called Turo. So it's getting back into the car share market. In the AFR, it says last month, shut down Uber Carshare, formerly known as Car Next Door. In its place, it announced a global partnership with US car sharing platform Turo. The tech giant had failed to make Car Next Door model work. Ironically, Turo had learned this lesson almost a decade earlier. It rebranded from Relay Rides in 2015 after discovering the rent by the hour model was fundamentally flawed. We learned early on in the US that hourly, local mobility focused model wasn't for us. It led to high risk, low cost trips. The economics just didn't work. So we pivoted. So I find this intriguing that a big company like Uber buys something for 105 million, which is probably a rounding error for them, only to learn the same lesson that the company that they've now partnered with.
Yeah, super interesting. And I'd be fascinated to know the terms of the partnership, but also that decision not to simply try and modify their car share product, but actually essentially kill it and partner with someone else.
Just hold on 1 minute. My father has arrived. Hello, Dad. Do you want to come and join a podcast? If you wonder what to say hi to Aaron.
Hey,
Hello,
I'll see you
how are
again.
you?
Good. How are you?
Aaron, Jack and Ash.
Jack and Ash, how you doing?
Going
So-
good.
That noise in the background is the renovations have started properly with the concreter I came to terms with finally. So he started. Your desk is a bit disheveled, but we'll clean it up shortly.
All right. Nice to meet you all.
Nice to meet you.
Wait, Don, did you end up paying 50% up front or?
No, Jack. 40. What? Look, what is it? Beggars can't be choosers. At a certain point, you just gotta roll with it. But the main thing is that we had a win. Anyway, let's get back to one of the things I did wonder is that often these companies are fairly decentralized. I could imagine like one department buying this thing at the same time that another department that's not talking to anyone is working on a global partnership, and it happens.
Yeah, that's a good point. It's interesting. The challenges they describe about short-term rentals by the hour, and what they're inferring or implying is that there's more damage to vehicles with that type of hire model, more overhead, insurance costs, and other things. Yeah, it's interesting to me why they couldn't just simply shift the features in the product just to target hire by day or anything else. But I think you're right, Don. I think it speaks to the size of the company and $105 million being a rounding error that they can write off.
From my perspective, like I've used Turo and I've used a number of these car sharing platforms, particularly in the US. Zipcar back in the day when it was, first cool and in and around, and we know that's also gone belly up as well. So I do think it potentially maybe there's something to do with inventory. Turo is very well known and you have to upload your car and create a profile. So if you're having to do that on multiple platforms versus being able to potentially share that across Turo and Uber. So if people are coming to either platform and it's one seamless profile from a user experience, it could be easier and therefore potentially a better play to get more people to have traction using it. That was the first thought I had of, well, how does this shift the user experience and being able to use both Uber and Turo?
I think that inventory one is a great point. I listened to a podcast with I think he was like the sixth hire of Uber on how they scaled into the countries. And at a certain point, acquiring inventory just became really expensive, really hard. Another point I would just make is that actually, back to your earlier point, Aaron, of why didn't they just do this themselves? At a certain point, companies become like slow-moving coal ships. They're hard to change. They're hard to turn. They're hard to get the culture to accept something new.
And in the case of Uber, it's no longer founder-led, right? Like Travis was booted and a lot of their original, that top-level team left. So I'd imagine it's a very different company now.
Do you think it could also be around the fact that if you're partnering with Turo, you're pushing the need for innovation and continuous improvement to Turo versus you having to spend your dollars on Uber versus expanding Uber Eats, expanding just their traditional rideshare, focusing their money on that versus having to also then divide up where they're focusing time and money into this program that seems like it wasn't working at all versus going, oh, these guys have got it sorted. We're just going to let them deal with it and take a clip.
That's a good point. And that point of focus and capital allocation, and if it works, then they can go and buy them later on anyway.
Yeah. It's interesting that the delivery aspect. I've been using the delivery feature in Uber recently. So with the wedding, we had to get the wedding flowers, and it turned out it was much further away from the wedding venue than we thought. So rather than sit in the car for an hour 20, just Uber deliveries got it. And then actually yesterday, Ash, picking up your swag, for me, it would have been an hour something round trip in Brizzy. I'm like, I'm just going to use the Uber deliveries feature. Someone went, collected it, delivered it to the house, $20 later, done.
Well, on Saturday night, it was the night before, I was doing this little thing on Sunday, and I didn't have sticky tape to tape my gels, and I didn't want to go out. So I think the delivery fee was $15. The sticky tape was $1.60 from Coles, and the friendly gentleman dropped it to my door.
So good. And when he dropped it off, how many times did you mention Ironman?
Well, he knew. When he arrived, I was obviously stretching and doing some push-ups, and
just tell by looking at you.
Just on the... Look, I think it would be fair to say that Car Next Door either had it and then lost it, or just didn't have it at all, but it lost product market fit, and it got shut down and it died. And that sort of is a segue to Ed released a second blog, a follow-up from his first one. And he said, why do companies lose product market fit? Blog 2 in his series, Losing Product Market Fit. He says, last week I talked about what it takes to find product market fit in a venture-backed business: vision, customer engagement, and scalability. In this week's blog, he's going to list out external factors that drive product market fit from a business: new customer requirements, opportunities in new markets, poor sales performance. The blog goes on to describe how these factors destroy the internal systems: confused mission, breakdown in communication, destruction of gross margin, and how ultimately product market fit gets destroyed and the business ends up in a downward spiral. This second blog is so spot on.
There's so much gold in this one. I think we could do an entire episode on this. And I think once he releases these series, it'd be good to get Ed back on a podcast and go through them.
100%. Because the issue is that it's almost like he's talking about specific companies, but actually what founders don't really realize is this is the common pattern. And I'll share my screen and put the chart up, but like this is so bang on. Company gets growth. For those at home, it's like this up and to the right line that then flattens out and then starts to dip. Now, I would say that this chart is actually a positive chart because the company sort of refines growth after this dip, but actually the majority of them plow into the ground and die because they don't realize these particular issues and what's occurring. So on this chart, what pushes down is new customer requirements. So often we see this, it's in our portfolio, it's in others that we have looked at, especially when moving to enterprise. The customer says, I love what you do. If you can just add these 15 features, we'll sign tomorrow. So the company goes, yeah, okay, great. Because I reckon those 15 features will scale to someone else. Spoiler alert, they never do. And then the next customer comes along and says, yeah, I'm going to buy, but just add these 12 features. And then what happens is you get this Frankenstein that just pushes pressure down on the business.
There are a couple of great quotes there. It doesn't take long for customers to go from wanting your product to wanting to build your product for them. And that other comment around the 2 to 3 mil pounds in revenue, it's based in the UK, obviously. You start shifting to everything being a product problem because you've essentially shifted from founder-led sales. You've got a sales team. When sales aren't coming through, there's friction and the sales team starts blaming the product because they're getting that feedback from customers. Like my lived experience with this, with Arinda, I got so frustrated with these inbound requests to build product features, which we would then do and no one would use them, or people would request things but wouldn't actually use it. So we shifted where we would test by simply putting a button in the software for the new feature and tracking with a counter how many times people actually clicked it. and also tracking how many support calls we got from people who said, I'm trying to use this feature and it doesn't exist, doesn't work. All the button did was a counter. That was it. Just reported back to our server. But we could at least get insights on some sort of measure of do rather than say. Many customers will say things. There's a difference with what they actually do. I'm not saying that was the most effective thing, but it worked for most features to get some. Most of the time it was, let's not bother.
I think a good one for, just a common one for Aussie and Kiwi companies is opportunities in new markets. So you might find product market fit in ANZ, but it's inevitable by the size of the TAM here that you're going to have to expand to another market. And we commonly play in the US, UK. And quite often you see founders raise their Series A, launch to the new market and neglect their home market. So it's just an evolving thing that always constantly needs to be checked by the team.
I'd agree with that. There's the new markets as in geography. The thing that I think screws most founders is it's new markets as in new verticals.
New verticals, yeah, agreed.
And they then are often trying to do both. New vertical, new market, and there's this shiny ball of string syndrome at the same time that they're trying to do new customer features for enterprise, and they screw themselves.
Yeah, I think it was the example in the blog's really good of your existing healthcare software platform, and then someone on your network who's at a bank says, oh, we need this. And then you automatically having this, oh, we should pivot or should we not? And from what I've seen in the market in particular, it's the founders who have a good head on their shoulders, seek advice from mentors or investors to go, should we pivot and try to focus on both? Or do we need to stay focused and nimble at this point and look at that further on? And even just from the conversations we've had about our portfolio, I know this is something that we've been discussing with Grease Boss on niching down, having a clear focus now, which I think is evident in this as well, where if you have a good product, people are going to want it in other industries, but nail your initial product market fit first.
So Ash, we need a list of those founders you mentioned before, the ones that take mentoring, and like, if you could just send a list of those through, that would be fantastic.
I think the other thing with that chart, Don, is like what Ed describes as the Ed effect. Capital comes in, and if you look at those revenue numbers, that's typically when often companies raise a big chunk of capital, and then there's this downward sometimes impact on revenue, or at least on growth. And I think we see this play out a lot. And often
the post-investment slump.
Post-investment slump, absolutely. And so I like this post for articulating some of the causality of that.
But after we sent the money for our last one, it's almost like there's a prayer we must say. And the prayer is, may the slump be slight and swift. Like, we've got to accept that the universe gives the slump, but just can it be as small as possible, please, so we can go forth?
I've got nothing to add to that one.
Very few companies don't end up in this pattern. What we don't want is you slamming into the ground because you've simultaneously gone too wide at a feature level, at a market level, at a geography level, chasing your tail. But at the same time, it's hard. The entrepreneurial impulse is, let's do more. And it's always 5 minutes to midnight. If I don't attack this now, someone else will. If I don't do it now, the opportunity will be lost. The reality is in 90% of cases, that's just not the case. But in one of the cases, it definitely was the case that they not only nailed product market fit, they went from strength to strength, and that's Safety Culture. Safety Culture announced this week that they've raised $165 million at a $2.5 billion valuation. It's the article in the AFR by Paul Smith says the 20-year-old company has revalued at $2.5 billion from $2.7 billion a year ago. In a transaction, its founder and chief executive Luke Annear said represented a strong result in a depressed market. All we can do is focus on building the business, and markets will go up and down and sideways. So we don't tend to really think about it too much. In this later deal, Airtree made its biggest entry investment into a company worth $40 million, as did superannuation funds Hostplus and Hester. Blackbird Ventures first invested in 2013 and in its latest round sold shares by some of its early funds, but then also acted as a buyer at the same time from a later fund from 2022.
One takeaway for me here, like that decrease in valuation, like we know of a company that just went back to market for a cap raise and had pretty much doubled their pre-money val, and they couldn't get the round away. And so I think this commentary for founders to understand the current state of the market, what you need to look like to be competitive to get a round done, and the signaling of overvaluing and not getting that round away, just look at Safety Culture. Great company, lower val than a year ago.
The second point that I thought was really interesting in this thread we were talking about was around fresh capital versus secondary capital sales, and how the press releases really didn't tell the truth around what that actually looks like. And the example in Simon's post that you've shown, Don, where it's the example of Combank shares changing hands. No one reports on that on a daily basis. So I think it's also really helpful for founders to make sure that they are not just taking a headline and they're actually looking at it in detail to understand what new capital is flowing in and understanding the difference between what that looks like in secondary sales. Is if you look at 165 million of so-called fresh capital when really it's 75 million, and 90 other million is the change of hands. It's a big difference in your headspace, I think, also as a founder.
Which I think also flows into valuation, because when companies coming to get capital and the majority is secondary, there's always a discount if money's flowing out of the company and not going to growth. If they were just raising the 75 million for growth, I wonder what the val would have been, but because the majority was secondary. But yeah, Simon Thomsen of Startup Daily did a post just pointing that out, and I'll put a link to that as well. And what Simon's saying there is the issue is that it distorts the figures. It wasn't 165 million that was raised for growth capital. It was only a fraction. But one of the commenters pointed out that it's actually a really good story.
Yeah.
The fact that in this ecosystem, 90 million of secondary sales is going back to early investors. Like that's a great story.
Yeah, great story. And again, shout out to Simon, like just good reporting, like bring it back to facts and bring it back to, I think just like reality. But I think the secondary story is great. The rest of it, there is something in there about funds selling to funds at the moment. And it's not just Safety Culture. We're seeing this even within VC funds, assets being sold between fund 1 to fund 2 and that sort of thing. But yeah, I think good post by Simon, great comment by Albert. Totally agree. Let's talk more about secondaries. The market appetite for it is growing a lot.
I really love seeing Craig Blair's post on LinkedIn. So he's the GP and co-founder of Airtree. So he first connected with Luke and Ian back in 2015 and passed for a number of reasons. But I just love to see the transparency, and now he's come back full circle, invested at this val and happily eats humble pie. Just love to see it, because this game, like, he's so right. It's a brutal feedback loop, and you don't want to let these opportunities go through you.
We don't have all the info, but I bet you it was Val. It's like always Val. We went to the rugby the other night. Aaron didn't because of his back and his age, and had to be in bed early and and all of that. But there was an investor there who actually put money into Canva at a 3 million pre-money. So obviously done very well, but said that they really wanted to own more. I said, well, why didn't you? He said, well, every round that then came, we just couldn't get our head around Val. Now, in the case of a Canva, that's a mistake. The problem is you can't just take, okay, we made a mistake in Canva, so we've got to then change our behavior across everyone, because for the 99 other companies, if you did chase and you did invest irrelevant of Val, I bet you the portfolio maths doesn't work out. And obviously here, Airtree's got their head around it. And if, look at a $2.5 billion valuation, if it can get to a fraction of the size of, say, an Atlassian, there's still a venture return from this point.
That's why I think you've got to analyze a deal, like analyze the company irrespective of the valuation. Like, is this going to be a winning B2B technology company? And you have to make that decision independent of what the valuation is. And we look at like the size of the opportunity, the team and culture, and then the defensibility, and then separately look at the VAL. And like, I recently listened to a podcast about Sequoia's investment into ServiceNow. They got in at circa 100 mil, but they were that sure about this company. It's now at $150 billion valuation. Like, they still got their outlier return. And like, if you tried to analyze that together, it's hard to justify that VAL of the game we play in.
One of the things that is going through my mind in terms of they've effectively waited a decade to invest. And we've discussed safety culture a number of times on the podcast. It just feels that the world is moving vertical from horizontal. And so they're investing at a time where we see a lot of companies attacking SafetyCulture's various verticals. And this investor that I spoke to the other night is also an investor in SafetyCulture, and we were having a chat, and his view is that SafetyCulture's too big now. Its sales motion can't do verticalization. Their product can't chase all of those markets that they're being attacked in, but where they think that they can still win is at the very big enterprise level, playing the horizontal game. And so his view is SafetyCulture's letting go of all the small vertical markets that are a great market for a smaller company, but too small for a SafetyCulture. And that's how they're going to then get to their 100 bill target.
The thing that was going through my head was if it's similar to what we saw with Salesforce, where they initially had, a similar kind of game plan and then had to really step it up and go, no, we're just going to attack enterprise, large business, and somewhat price themselves out of the market for smaller businesses to even utilize their services. But they have formed strategic partnerships, integrations with the other players who had seemingly come and attacked them in those smaller vertical markets. That was the analogy in my head at where I was going, is this going to be a similar play of what they're thinking, and how you could potentially even look at those small companies who are attacking them in those verticals and potentially try to get in on that and get a return from a potential buyout or a partnership in the future.
As long as the company is able to be comfortable with losing those markets and going after that big enterprise, sometimes they want to try and do everything. And do both, and then they divide up their organizational energy, and before you know it, they're not achieving anything else. But clearly, Luke and his team are very, very good operators, and they should not be underestimated because of what they've built and the way they built it.
Yeah, spot on.
Now, in this one, there was $90 million of secondary that investors have got, but it doesn't always end like that. And there was a post by Dirk Shamler during the week that I thought was just interesting because we're seeing more of this, even though it's not being talked about. There was a post by Jeremy Blalock, and I think this was on Twitter. He said, recently learned that Adelo, the company I founded and ran for the first 3 years, is being sold for $2 million, and I'm getting $0. Yeah, $2 million, which is less than their current ARR. We raised $10 million, and there's a $1 million employee carve out from the $2 million. So investors are getting 10 cents in the dollar. I think it's important to talk about because at the moment, chickens are coming home to roost.
Yeah. My first reaction to reading that was, yeah, welcome to the party. That's like, this is common. And yeah, I don't really have much else to add. It's like, yes.
Well, I totally missed what you didn't have much to add. So I've got no idea.
I was just saying that my reaction to reading that was just, yeah, welcome to the party. Like this happens.
Oh, we're in an empathetic mood today, aren't we?
Look, having made a number of investments that for a variety of reasons went back to 0 or cents in the dollar.
Yeah. And we don't know the background, but I think the key thing is people would assume if you've raised 10 million, you're minted. Everything's going to work out. Wrong. What we found from this last cycle, companies that raised too much money too quickly actually shot themselves in the foot. They didn't build healthy companies. They burnt through the cash. They then ended up having to accept shitty terms, and then this happens. So for those that are thinking of getting themselves into that position, don't. For those that are that position, what can you learn from it, and how can you get out of it as quickly as possible? But that's where I think founders and investors need to think through things like liquidation preferences. In the moment, when you're trying to keep your valuation high and you don't want to take your medicine on that and you want to keep it flat, and you say, okay, well, I'll give a liquidation preference because it's all going to work out. Well, statistically, it doesn't. And then what happens is instead of just taking your medicine with no liquidation pref at a much lower val and dealing with the dilution then you've got a liquidation pref. Sometimes the business just can't be sold more of and you get left with nothing. Whereas in the other scenario, if you took your medicine early, you would have been left with something. But the reason why I thought it was important to put in the show notes today is that it's just happening more and more. And I think over the next 18 months, we're going to see a lot of pain. And for me, I find it heartbreaking because having been there myself, when you put 10 years into something and you come away with nothing, it's hard.
Yeah. Well, my personal experience, you put 10 years in, you sell it, you think you're done, and then you realize you structured the exit wrong and you end up back negative. That's demoralizing.
Working from your car.
Yeah.
I reckon some cops are going to come do a welfare check on you in a minute. Now,
Just on that one though, I was looking for the most recent data, but the last data I saw, something like 97% of pre-revenue startups fail. Then it went to 95% of seed stage, but even by Series A, like having successfully raised a Series A, the failure rate was still above 70%. I'll try and find some updated stats for a future one, but this thought that, well, I've got that big capital lick squared away means therefore I'm protected. The data just proves no, that the risk of failure is still incredibly high.
But if founders were trying to like apply the data, they wouldn't even start the company. And that's why we back them, because they're stupidly optimistic and like they want to win despite the odds.
100%. You're spot on, Jack. Naivety is a beautiful thing.
yeah, so if you're stupid, apply here. Is that what you're saying, Jack?
Yeah. That's why
What do we
we got a podcast and we're 100 eps in.
What did Jason Calacanis say? It's too stupid to fail?
Yeah, too stupid to quit.
Yeah.
Too stupid to quit.
Too stupid to quit. Yeah, don't look at the statistics. Now, companies that thrive are the ones that actually, at the core of it, are, in this environment, very good marketing and lead generation companies. 5 years ago, it was sales-led, outbound. People that could sell ice to Eskimos, they were the ones that absolutely ruled the roost. What we're finding now is that outbound is dead. Sales is hard because there's so many competitors in each vertical, but people that can generate unique leads within their ideal client profile at scale are the ones that win. And Ash, you actually found this article, and it's called Why Startup Marketers Should Be Diagnosticians. This is advice from OpenAI's and Stripe's first marketing hire. What did you like about this article before we jump into it?
I just thought it was really interesting and a fresh perspective of how I feel a lot of people think that marketing is very much lipstick and doesn't actually have science behind it. And instead, I think she really highlights that it's part science, it's part explorer, it's part creative, and it's also part statistician. And I think that it's something that a lot of founders think of as a secondary or a nice to have. I think she really articulates well that it's not a nice to have, and how to interview for someone who's right for the organization, and goes through some of the key areas of line of questioning, but also just how you can even think about your marketing from a more scientific and statistical manner, which I think is powerful and something that if I were a founder, I'd want to understand more and learn more about.
One of the bits I liked in the article, I don't think I've seen it before, but I may have, but they talked about that the marketer is T-shaped. And what a T-shaped marketer is that they're actually quite broad in a lot of things, but they go deep in something. And I think that's quite right, because what they say is before the marketer can build out a team, they'll need to do a lot of the nitty-gritty work themselves, from writing blogs to running growth sprints. That's why she recommends a generalist with experience across many sub-disciplines, but likely has deep knowledge in one, which is the vertical bar in the proverbial T. And I think that's right. Where I've seen success in a lot of the portfolio and a lot of my companies was actually in the early days, a generalist that could get stuff done. The challenge, though, is actually in the pivot. And one company we looked at and that we ended up not adding to the Tribe portfolio is that they were past the generalist phase, but still wanting to play generalist, but actually they needed to move to specialization. And if they didn't move to specialization, they were going to have a lot of trouble.
Ash, totally agree with your takeaway from it. The bit in there I particularly liked as well was calling out bullshit and vanity metrics. And I think I see this a lot. Founders tend to be better at measuring very top of funnel vanity metrics, but not tracking their conversion down the funnel. And I actually see it in pitch decks, even at pre-series A stage, where they're quoting number of social media followers on different channels and top of funnel website hits, but they're not converting it. And this is part of the work we did around the go-to-market canvas and Jack, you helping reframe that sales funnel. And like this session I have to deliver later today for the accelerator, the big aha moment is when you tell the founders, okay, now if you've got your forecast for the next 3 years, flip your sales funnel upside down, look at your current metrics, work backwards. How many cold calls do you actually need to be doing every day? How much do you actually need to be spending on these campaigns? And when they do that maths, they realize that they're not doing that level of activity. So I think this article is really powerful. I think founders should take a read and really challenge yourself on that. Are you being scientific? Are you looking at your data? Are you not just anchoring on vanity metrics, but looking at the meaningful metrics?
Well, we see it all the time in our industry when funds, and sometimes I'll trot it out if required. It's like, oh, we look at 500 deals a year, but we only do 3 investments. It's like, yeah, but 300 of them were offshore spam.
100%.
Wanting you to invest in shitcoins. Like, yeah. The other one that was in there that I think is important for the companies that listen to this podcast is don't conflate brand pedigree with impact. And I see it all the time where companies, and it's not just marketers, they hire someone from like a really big brand or a company that's much more mature down the life cycle than them. But the people that they're hiring there don't realize how powerful that brand was, how much resource they had, how much support they had, all of these different ingredients while they were in that company. Then they come to this early stage company and are expected to get their own milk, their own tea and coffee and sort their own shit out. Like 9 times out of 10, it fails.
Yeah, 100% agree. And I think that ties into the last point I thought was particularly powerful was the live strategy session. So instead of what your 30, 60, 90-day plan is, just get the person in the room, talk about the business, have them talk through strategy live in a dynamic session, see how they can pivot and be a generalist. And I think here, Don and Aaron and Jack asked me this question of, well, how are you going to handle working at Tribe from, JP Morgan, where you probably had all the fancy tools? And look, I didn't have the fancy tools, and that's why I'm comfortable in this environment. So there still are those pockets within those organizations, but this team did their homework and made sure that I wasn't expecting that I had an analyst working under me to do all the grunt work, and that I knew that was going to be me. So I think it's the brand equity works in a way, but you do need to understand what that person was really doing inside the business.
Yeah. And then finally, I think was really important, create a state of the funnel report, which comes back to something that Ed and us have talked about a lot, is that often companies don't concentrate on their funnel. And with some of the stuff that Jack has pointed out with the go-to-market canvas, like at the end of the day, you've got to be measuring. And if you don't measure quickly, it means you're not going to find out what's not working. And if you're not finding out what's not working, you're not going to be able to pivot quick enough.
Yeah, the way I view a funnel, it's just an accountability tool. And startups by default are resource constrained and have to do more with less. And if we've got a small team, everyone has to be accountable. Everyone has to be pulling more weight than they should actually be able to. But yeah, funny thing, like in the early stage ecosystem, it's quite often you get like, I have a marketing problem, but like what is a marketing problem? And the way I look at it is, it's like, do you have a demand problem or do you have a conversion problem? And when you diagnose that, it's super clear in the funnel what you need to fix. And I just think like another call out as well, like there's brand awareness and then there's performance based. And in the marketing world for early stage, like brand can come. It has to be demand based, has to be performance. And that when you have a performance based marketer, that is exactly like a sales outbound tool. Like instead of going outbound, you're trying to turn them inbound leads. And it's so powerful when you get that right. But understanding the difference, because marketing is such a broad category, understanding what you need as an early stage founder in the team.
Now, one of the big parts of marketing is getting your personas right. And I thought this was funny. So I'm going to read you a persona. Male, born in 1948, raised in the UK, married twice, lives in a castle, wealthy and famous. That is actually the persona of 2 people. One is Prince Charles and the other is Ozzy Osbourne. And so the purpose of this post is just to be careful about personas, because if you were just trying to track down males born in 1948, raised in the UK, married twice, living in a castle that are wealthy and famous, you're going to get Ozzy and the large-eared Prince, and you're going to have a bit of a problem in your conversion.
I love this post. It's such a good point. Like how you define your ICP and your personas. Like what are the characteristics that you're tracking? We see this a lot with companies like in the B2B space. They'll define say they're targeting accounting firms, but they'll define it in such broad ways that you get such a collective mix. Some of them have internal IT, some of them don't. Some of them have multiple locations, some of them don't. Some are targeting different customer segments. Like being really specific on the right criteria is the piece that matters. And this post brought it back to looking at the problems that they experience. So including the problem space as part of the persona, and obviously hoping those problems actually overlap with what you're doing. But yeah, great post.
Jack and Ash?
I got nothing to add there.
No, personas are a fun exercise, but really useful.
Which segues a little bit to, like, pretty well all of this podcast is advice, and you've got to be careful who you take it from. And Paul Graham created quite a stir last week when he wrote an article, and the article was called Founder Mode. In that article, he talks about taking advice, but there was a couple of clips that in a post says, as Airbnb grew, Brian Chesky got advice, hire good people and give them room to do their jobs. He followed this advice and the results were disastrous. Why was everyone telling these founders the wrong thing? What they were being told was how to run a company that you hadn't founded, how to run a company if you merely been a professional manager. In your journey as a founder, you'll hear a lot of unsolicited advice from VCs and consultants that's well intended, but often tends to be wrong. I've been working with one of our portfolio that has been getting a whole lot of advice that is perfect for the early stage startup phase, but kills you in the later phase. And I think that what is missing from some of these discussions is that there's some transitionary sequence stuff. So in the early stage of Airbnb, if you just hire good people and let them do their jobs without the right systems, processes, controls, rhythms, that's a disaster. And founders all the time get this leadership coaching type stuff where you got to step out of the way and you got to actually, if you delegate without systems, processes, and controls too early, that's abdication, and abdication leads to bankruptcy and things turning to shit. Before you go and just try and hire good people and just leave them alone, there's actually a series of steps. Not only that, you shouldn't do that on every role. You should actually have a systemic approach to it. There are certain producing roles in a company, certain administrative roles. They're the roles to do first. They're the roles to get in place, decentralized, get the systems and process. If you hand off like the high functioning roles, the entrepreneurial roles, the creativity, if you try and hand that off too early, it then turns into an absolute disaster.
Yeah, and the other thing I'd riff off that, Don, is when, and it's interesting, like this post highlights advice from investors and encourages founders to get advice from other founders, which I totally agree with in theory, because even later stage founders tend to give advice from that stage. And I think of a couple of very successful entrepreneurs I know who give advice from their memory of the later stage of their business. And one specific example was advice around, I put a board in place and put these people on my board and it really drove our performance. But that advice was to a pre-seed company, which that sort of governance is just going to potentially kill them. So I think having that watch out of what place is this advice coming from in the life cycle sense. I think investors, we're guilty of, and founders too, an experience sample of N equals 1, and then projecting that onto all other situations and all other founders and all other companies. And the other thing I'd say with this that made me think of is how many times we're seeing as investors conflicting advice to the portfolio companies from the other investors. And the poor founder in the middle of that having to make sense of conflicting advice and mentor whiplash. And I think the fault that founders can make is biasing towards listening to that advice, which I guess is positive or reinforcing their current strategy, rather than actually taking a moment to unpack the conflicting advice.
Or coming from the biggest check.
Yeah, very true.
The biggest check often doesn't have the experiential stuff. And look, we've got to be mindful and careful here. His investors having a crack at others, but we just see it all the time. And the biggest problem I see is it's not life cycle located. People are giving generic advice as if it's one size fits all. Like, if you haven't been a founder, there are some things that I don't think you should give advice on, but that doesn't mean that you're an investor that can't give advice, right? What you actually need is a complementary team. You need people that have different bits and pieces. It's best if you know your lane, but then from the founder, it's best if you know their lane, because sometimes it's hard for you to see yourself, and the person might not be trying to be a dickhead. Actually, that's not their lane. So smile and say, okay, but know that you've got someone in your corner that it is their lane. And that's where I'm going to actually take some of that advice.
Yeah, Don, I think that's really powerful. Know their lane, and that applies to anyone outside of the founder. And something you say quite often when you're talking about frameworks and models is all models are wrong. Some are useful. Same applies for advice. You could say all advice is wrong, some is useful, and ultimately it's up to the founder to filter through all of the noise and find out what is the useful stuff to apply to their company. And someone sitting on the outside doesn't have all the facts. So the founder has all the facts, and it's up to you to really determine what's going to be helpful.
Like it. This may be completely useless, but question for the three of you. From a founder's perspective, would you suggest that think about your investors from a portfolio approach by looking at them and going, right, so at this point in my life cycle, I know that I need investors who can help me in seed, pre-seed, Series A. Now I'm going to Series A. I need a different type of investor who has more experience taking companies from C to B, and actually start to think about the difference in advice, but in particular the experience that they have that can back up whether advice is helpful, and success from that way from investors as well.
The only problem is there's no certification program for investors that say, okay, I'm certified for that. So founders do need to dig through, and the best way to dig through is actually talk to their portfolio. But ideally, make sure you've spoken to just as many of the portfolio where it went wrong, because that's really where the investor will show their true colors. If the conversation is, yeah, it went wrong, things didn't work out, but actually they were fair, they stood by me, here's the advice, and they are definitely competent in this phase, great. But too often we only talk to the people where everything was beer and Skittles, and then people pattern match wrong. So I think portfolio approaching investors is absolutely right, but being able to work out who is actually the real deal. And I think the only way you can work that out is by talking to other investors and portfolio company.
Yeah, it does take a while. It does take a while to work out the difference between what the investors might say is their expertise versus their real value.
We'll discuss it live on air, and you can give me some feedback. But with one of our portfolio companies, there's an investor that we like and respect, but for some of the advice, they're wrong, like really wrong. And it is my particular domain expertise, not only from experience, but from training with a global organization. And if they keep pushing this founder or founders down this path, they're going to cause some serious damage. So what I'm actually going to do, rather than just leaving the founder as the linchpin, is get the founder's permission, but to call this investor and say, hey, look, this is my perspective. This is where I think, because this investor's on the board and we're not, and actually have that conversation with them and openly, I'm not asking for their permission or even for them to fully understand, but just to be open and honest that I'm giving absolutely contrary advice, and this is why.
No, I think it's a great approach. It stands by our values. And it's good. I think it's needed because the founder's in a tough place and they're trying to be head down growing the business. So I think if we can take some of that burden or ease that in some way, absolutely.
I'll have my medal on at the time to build. I just don't come at this as a normal civilian. Anything else you've got to add?
Nah, nothing to add on.
And then the final one before we get to some Sharts, Kevin Jurovic did a post. These are the major VC red flags. Spends more than 1 minute on a DocuSend. I think that's true. Like DocuSend is almost gotten to a point where it's like you're not actually supposed to read the thing that you're signing, it seems to be. Only has one Patagonia vest. Actually replies to investor updates. Used to be an operator. Doesn't root from the sidelines. Fails to say, we invested at inception. I had to Google this. Doesn't drink La Croix. You being all worldly and international, do you know what that is?
No, I had to Google it.
Right.
Giving it some fancy drink.
Wasn't stuck in the mud at Burning Man. Doesn't listen to the All In podcast. Uses phrases like synergy or 10x. Hasn't tweeted about AI in the past 24 hours. Hasn't been meaning to start a podcast.
How good's that one? That one is so good.
Well, especially after AB last week, certainly made her thoughts very well known on the VCs with their own podcasts. So yeah, so for founders listening, any VCs that have that on the list, total red flags.
It's so good.
I have Googled it. It is sparkling water, and I have drunk a lot of it now that I see the label.
Oh, it's just sparkling water, is it?
Yeah, it's like fancy sparkling water.
Yeah, right.
Yeah, it's a Whole Foods type of vibe.
Okay. Well, let's jump into some Sharts, shall we?
Let's do it.
This is the real gross household disposable income per capita. So one's for the OECD and one's for Australia. And what you'll see is that the OECD is back going up and to the right. Australia's going down And the reason why is we've still got a very high inflation rate that is destroying our purchasing power, which, it takes like $60 to feed the kids through McDonald's if I want to have a crispy chicken wrap.
Yeah, how do you think Aaron feels? He's got
Oh, family of
sport.
6. I was telling Jack the other day, like we just stopped for a snack and it was $80.
When did this happen? Macca's was so cheap.
Telling you, double income, no kids. Where to go?
Well, given my father's in the office here, my father's favourite thing to do used to be to go through drive-through and ask for a POV cone. Because back in the day, an ice cream cone at McDonald's was 30 cents. And it was called a POV cone. Until one day they rebuked him and wouldn't serve him because they just got upset of it being called a POV cone until he correctly asked for the 30-cent cone. So now this one, health employment as a percentage of labour force. So you'll just see that Australia used to be in line with United States and Canada, right? From 2008, around the 10.5% growing to 13%. What do you think came along at around that time that led to such a big growth in health as employment? NDIS. Now, I'm all for it. I know that anything a government touches, as we've discussed previously, they've got sexy fingers and they just fuck it. But I think it's actually a good program that over time will weed out a lot of the stupidity and a lot of the wasted. But you can just see the pressure it's putting under some of the labour force statistics compared to other countries.
It's a sharp uptick, isn't it, compared to the other countries?
And I just think it's important when you've got co-founder like Aaron, obviously is going to need a lot of medical support as the years go on, that we have a really functional health system. New Zealand seems like it just couldn't give a shit about anybody's health because it's been flat for the better part of 10 years.
Or are Kiwis just healthier than us because they're out doing stuff, living the best life?
They just shut the border. 5 million of them. They're all good.
Oh, they all moved to the Gold Coast, so they don't need healthcare in New Zealand.
If your diet consists of fish and chops and a Pepsi, then you're probably doing all right. So there goes 30% of the listener base. So unemployment in millions. This is a chart that Trump is using to try and drive quite a lot of divisiveness. I don't have the answers as to why this is, but for listeners at home, up until COVID 2020, this is the US employment level, millions of people employed in the US, starting from 2010. The foreign-born and the US-born were roughly in lockstep. Then COVID happens, and actually foreign-born on the left is outstripping US-born. US-born is flatlined, foreign-born is going up strongly. Now Trump is trying to use this as a reason to stop migration because the jobs are being taken. In my life's experience, simple explanations like that aren't actually very good explanations. You've spent quite a bit of time there, Ash. Do you have any insight? Is it just maybe the Americans don't want to work anymore?
No, it's hard to tell just from one graph, but from my experience and my friend base being mostly foreign-born, American employed, is that our visas have such tight restrictions on us having to work to stay in the country. So there is a lot of pressure, and your visa is also tied generally to your employer. So if you leave your employer, you have to get your new employer to sign a new visa, pay for a new visa application. So there is a lot of friction. And it means that you can't stay in the country unless you have a job, which also in COVID meant that a lot of people had 90 days to find a new job, sponsor a visa when they were made redundant. So you can see how that uptick and downtick during COVID was shorter for the foreign because they didn't have an option. So you had to leave the country if you couldn't find a job.
At the beginning, you said it's hard to tell from one chart. Just one thing to learn about this whole podcast in this segment is that we're all about making random commentary without the right information that doesn't actually add value or make any sense. So just as long as you've
That answer
I'm
was too
trying
good.
to be less logical.
Yeah, like we're going to have a chat after this because you're ruining the vibe by bringing too much like actual analysis to it.
Yeah,
I can hear the feedback this week already. More Ash, please. Less the rest of you.
Now, another chart on US job openings versus unemployed persons. We can see two lines here for those at home, the job openings versus the unemployed people. Job openings is just been dwindling since about 2021. So there's less and less jobs open. Then it lagged by about 12 months as the unemployment started to rise. And now these two things are starting to cross, where there's about the same amount of job openings as there are unemployed people. But obviously there's the jobs and the people don't cross over for whatever reason. But what we do know with that unemployment rate is once it starts moving, it tends to keep moving. And so that's going to be interested. And last month, this is a chart of the yield curve inversion. So this is the US 10-year minus the 2-year. As we've discussed on the show many times, the yield curve historically has been one of those things that people have used to say that it predicts the conditions that lead to recession. It didn't this time, but one of the reasons potentially why is the sheer amount of money that was pumped into the consumer delaying things by a couple of years. But we're about to now get the opportunity to test it because we've now exited the inversion. And historically, it's around about 12 to 18 months from the exiting of the inversion when the recession actually starts. Now, keep in mind, a recession is 2 quarters of negative growth in a row. So the problem is you don't actually know you're in a recession until you're in the rear vision mirror. And it's one of those things that gets reported, at least to begin with, in hindsight. So I personally am not yet of the view that you can just discount this. I think you've actually got to wait to see what occurs. But as you can see, it was a long time that it was inverted. And this is happening at the same time that the ratio of the S&P 500 tech sector to the broader S&P 500 is actually still fairly close to record highs from back to March 2000. Now, it's come off a bit from that drop, but you can see what happened in March 2000. Once that body in motion started, that ratio totally flipped and tech stocks got smashed. Now, will AI be enough to deal with that? We'll see, but this chart highlights how much volatility is flowing. This is a chart that shows the daily movement in billions of dollars of NVIDIA's market cap. And you can see that for a long time, up until 2019, it was hard to notice, but just with the increase in NVIDIA's market cap and the volatility of the stock, it now has peak swings of $320 billion increase in a day. And the biggest loss in a day is $279 billion in a day. This is just getting wider and wider and wider. This is insane.
That's incredible. I'd like to see it as a percentage of market cap, but that looks like, for listeners at home, it's like a bloody, what do you call it?
A sound wave that's getting louder and louder and louder. Yeah.
Yeah.
Yeah. It's massive. It's not quite enough to trigger a trading halt, but it's not far off.
What's been interesting is that there are some defensive sectors in the stock market that people generally fly to during recessions, or at least pre-recessions, and they're normally healthcare, consumer staples, utilities, and real estate. And as the S&P 500 has had some wobbles and started to pull back, it is interesting that the other ones that I just referenced have started to make higher highs and higher lows. And enough higher highs and higher lows tends to be a pattern towards things starting to trend. So there's certainly some investors out there that are moving into defensive areas, either precautionary or because they've got a better crystal ball than the rest of us. What we're starting to see is that a few things are moving in lockstep. So that yield curve, it is actually started to move with that unemployment rate and the consumer expectation versus present survey. And what we can see from this chart for listeners at home, going back to 1985, when these things move, so when the yield curve, unemployment rate, and consumer expectations move, they tend to move together. And when they go up, they keep going up. And once they start coming down, they start coming down. And we're effectively coming off record lows for all three of those. And so if this is the beginning of a cycle, we're only in the very early innings that can last a decade or more and bring some pain. What a happy episode this has been. So just a couple of random things that I found. I thought this was quite funny. So one is a brick and one is a sponge, and they're both having water poured on them. And under the brick, it says listening to respond. Obviously, the water's not going anywhere, whereas a sponge is the listening to understand.
I love that.
I actually like that, Don. That's a good one.
Sorry, I didn't hear what you said. I wasn't listening.
Jack, you are the quintessential sponge.
Absolutely. I'm just waiting for him to start throwing the bricks back. And then this made me laugh because this is something that I'm trying to work on in my life's journey. It's just two people talking. One's obviously a guru, one's a normal. The guru gets asked, what is the secret to eternal happiness? He says, not to argue with fools. The person says, well, I disagree. And he says, well, yes, you're right. And that's the sort of consciousness that I'm trying to develop. You can critique how it's going. And without wanting to get too mushy, I thought that this was actually quite correct. If you're wondering who your people are, they are the ones that make your heart feel seen and your nervous system feel calm. Yes, it's that simple. And I think that's right. It's if you feel calm and your nervous system isn't spiking all the time, you're probably in the right place.
Don, look at that.
Aaron, he didn't say it was about us.
No, thank you. You're quite right, Ash. It's given me an opportunity to reflect on this. And while I've got you all here, I'd like to have a chat.
It's the new Iron Man community that is now part of. He feels this sense of belonging.
I feel seen and heard. Although I didn't feel seen and heard when the official yelled at me from the back of a motorcycle for being too close to another participant. But it wasn't my fault. They pulled in front of me. I'm not going to slow down for them. But anyway, apparently the rules say you're supposed to. So next minute, I'm almost getting into a shouting match while I'm on the bike and he's on a motorcycle. And anyway, what are we looking forward to?
I'm looking forward to Friday. We've got a session with one of the port codes, Don. And then after that, we're catching up with our AFSL license holder, Interfinancial, for a lunch. And then I'm catching up with Terry Woodcroft after that as well. So Friday's going to be a cracker of a day.
Great. Ash?
Yeah, I'm looking forward to chatting with our portfolio companies and our investors and getting to know everyone better. And yeah, talking more about Tribe.
I don't have any plans this weekend, so I'm actually looking forward to not doing much, but I'm looking forward to getting this memo over the line and then taking that to the syndicate.
Well, I'm going to the farm for the weekend because it's the beginning of school holidays, I think. So that's going to be awesome. And there's a chance I might stay for a couple of days and we'll do the potty from there. I've always said Elon's a good guy. I'll take the Starlink out as well.
Oh, awesome. That'll be good.
Well, Ash, you've done exceptionally well. I don't know why you were worried. Great to have you on the team. And
yeah, that was awesome, Ash.
Looking forward to the future.
Thanks, team. And Jack, yeah, no sweat patches.
Hey!
Yeah. Throw you under the bus already. Awesome.
All right, guys.
All right, see you guys.
Awesome.
Thanks,
Bye.
Tim.